Today, the yield curve inverts briefly. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and property news with a distinctively Australian flavour. The fears relating to the coronavirus and weakish consumer sentiment from the US, plus the Fed's hold decision, turned the tables on the US yield curve overnight, with the 3-month rate 2 basis points higher than the 10-year rate at one point. It's now slightly positive, but this is a sign of greater uncertainty. Plus, a measure of core US inflation released on Thursday showed price pressures slowed to an annualised 1.3% in the fourth quarter from 2.1%, a weaker figure than analysts had expected and below the Fed's target. The dip will be seen as a warning signal because it has inverted before each of the past 7 US recessions, and the last inversion was at the height of the trade war. But is also driven by the thought that the Fed may need to pump more liquidity into the market, despite the assurance yesterday that they planned to ease back their open market operations in the next few months. This means buying more treasuries out along the curve. Price up means yields fall. Clearly, investors are looking for some form of safety, and buying treasuries out along the curve is really the only way to do it. And Bloomberg says that falling yields also triggered other market dynamics, which are exacerbating the move. Convexity hedging, when portfolio managers buy or sell bonds to manage their duration exposure, is back in play. As yields fall, they make purchases. The sequence of a swift drop in yields and curve flattening unleashing convexity-linked forces that restarts the cycle is a recurring feature of the Treasury market. A massive wave of convexity-related hedging in the swaps market in March helped send the 10-year yields to levels then not seen since 2017. And that came after the Fed took an abrupt shift away from policy tightening that they'd been doing back in 2018. The Fed went on to cut rates 3 times over all of 2019. And other factors may also be at work as well. Structural demand for long-dated treasuries linked to liability-driven investment and hedging from foreign investors, including Taiwanese insurers, has helped to drive the curve flatter, according to Citigroup. Now, we think it's too soon to know whether this is an overreaction, but once again it underscores markets are on a hair trigger, so expect more volatility ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.